Hello there, welcome to a quick demonstration on a car loan analysis. This is a pretty common type of activity one would want to do whenever they are thinking of, borrowing money to buy a car, right? So first of all, usually you tend to think about, what type of a car do I want and what will be the purchase price? And usually we do have a budget, right? And of course, once you know that, here we just want to demonstrate three options that one can actually use, right? So we're going to use the option A, where we know what our purchase price is going to be, and then we do have a down payment and we do have a trade-in, right? And then of course we take all that in consideration so that we can figure out what the amount we need to finance. That's effectively the money we'll actually be borrowing. Again, I'll be able to explain the impact of that, the difference between having a down payment and the trade-in, and as opposed to having none of those. What does that actually mean? It does have some implication, right, on how much interest you're actually going to pay, the interest rate, in addition to, of course, whatever your credit score is going to be. All those will be factored into the risk of the loan itself. So that is actually factored into the interest rate, right? And again, it's to some extent, one may think, oh, there's a little bit of cheating going on, but it's all about factoring in the risk, right? So basically, that's how business actually functions. You have to factor in the risk that's actually associated with that particular money you're actually borrowing or lending, right? So here, let's say option A, we had a down payment of, let's say, $2,000, and then we are trading in an old car, and maybe they give us a valuation of $4,000, right? Which means then the money we're actually going to borrow is actually $12,500. Then, of course, we determine how long do we want to pay this particular loan. What is the period we would want to, let's say, for example, want to pay this over 4 years. Okay, and then what will be the annual interest? Let's say, just for argument's sake, we say it's 8%, 0.08. Okay, and then what's going to be the monthly payment? Right, to calculate the monthly payment, we actually use a function which is called payment, which is a function that's actually available in Excel. So all we do is we enter the equal sign, call up the function itself, it's PMT, right? Double click on it. And then, of course, we know that our interest rate is actually 8% per annum, right? So annually. So therefore, we click on that, and of course, we divide it by 12 because there are 12 months in a year, because we want to calculate the monthly payment. Right, and then in addition to that, what is the number of periods, right? So it is going to be 4 years, but we know that we'll be paying on a monthly basis. So it's 4 years multiplied by 12. Okay, because there are going to be 12 months in a year. All right, and then finally, what is our amount? So it's actually the present value, so we can click on this value there and then closing parenthesis, and here we can actually see that our monthly payment, right, for the 12,500 over 4 years at an interest rate of 8% is going to be $305 per month. Right, so what is the total payment then? So what is the total payment? This monthly payment multiplied by the total number of payments, which again, as we saw earlier, we said it's 4 multiplied by 12, because we'll be paying on a monthly basis. And we can see that the borrowing of 12,500, when we add interest to it, it's actually going to end up being 14,648. So to us, that's going to be the cost of the car that we actually bought. So again, we can actually go ahead and find the difference between the total payments with interest and the money, the principal that we actually borrowed. And we can see that by that, we'll actually have paid 2,148 in interest. Right, so let's do another experiment on the right side here. Now that we've already calculated all this stuff here, we can actually copy all these amounts and put them into the next column, and we can also copy them into option C as well. So here we can actually play around. That's the beauty of this. Once you've actually created a framework, all you can do, you can play around, you can plug in some numbers and just see the results, right? So let's say for option B, we didn't have a trade in car, right? But we had a down payment of $2,000. Okay, so which means we will be borrowing $16,500, and you can see already on a monthly basis, it's actually going to be $402, and that's going to be a total of $19,335 when we include the interest of $2,800. And option C, we did not have a down payment, we do not have a trade in, and we can see that the interest will be $3,179, and the total, when we put the interest in the total and the principal together, it will be $21,679. Now, what tends to happen then is that the interest is reflecting the risk that is associated with the loan, right? So in a situation like option A, we are likely to negotiate a better rate, right? Because we have actually saved for the down payment. We also have got a trade in car. So chances are we can negotiate with the bank and they can actually give us 6%, for example, 0.06. Right, and you can see that our monthly payment will actually come further down to $293, and which means that our interest rate will also come down to $1,591, right? Because we do have an advantage a little bit here because our loan is less risky, right? Because it does show that there's a little bit of discipline in our preparation to buy a car. That's why we had to plan for a down payment. We also, of course, we did have another car, and we were actually able to get a good valuation of $4,000. And because of that, our interest rate, we have the leverage, right, to negotiate the interest rate to come down a little bit. Whereas when we don't have any down payment, we don't have any trade-in, it's a little bit harder here, right? There's much more risk that we can assume, in this particular loan. So because of that, you want to take to factor that in your interest rate. So you're likely to pay a higher interest rate because of that. So there's a good chance that option B and C will even have a different interest rates there as well. So, it's I'm hoping that this demonstration gives you some idea of what determines the interest rate. And again, also here in the background will be the credit score. What is our credit score? All right, will also be an additional leverage that we can actually have to negotiate a lower interest rate, which means that the cost of borrowing will be reduced a little bit. So I'm hoping that this kind of gives you some idea, just to understand what happens, with the borrowing. What does interest rate actually reflect? And what about your credit worthiness? How is it actually determined? The variety of factors that will be taken into consideration so that the right interest rate is actually determined, and of course the necessary approval, it actually takes place. Otherwise, that's all I have for you. I hope you find this very helpful, and again, as usual, please like the video, share the video, and be sure to subscribe. And again, don't forget to comment if you need to provide me with some feedback. Thanks so much, and bye for now.